Another very strong employment report. And so the way the bond market has interpreted this is, okay, now the Fed knows that it has to raise the Fed funds rate another 50 basis points. So right now we're at 0.25% to 0.5% is the range for the Fed funds rate, and many think that it will go now as high as 1%. And as you may know, we have been flagging that the bond market itself is flagging warning signs to the Fed. And so we'd be surprised if they go the full 50, especially because the bond market is sending stronger signals today than it has for some time. The yield curve has inverted. The 10-year Treasury bond yield is below the 2-year Treasury bond yield. And it's been, and when we get to the bond section, I'll talk more about the yield curve. But that is a sign to the Fed that either growth is going to disappoint or inflation is going to disappoint, or both during the next few months to a year. And so we think that some on the Fed have been signaling, hey, and in fact, I think the Fed president, the president of the Minneapolis Fed, Kashkari, said, maybe we should be watching some of these other indicators. They do not seem to be suggesting that inflation is baked in the cake, meaning embedded now in the system, never to go away. That's the great fear, that we're in a replay of the 70s, where we reached double-digit inflation and interest rates before Fed Chairman Volcker was able to wrestle inflation to the ground. We don't think that's the case at all. We think the bond market is sending signals, and it's not just our bond markets, bond markets around the world, sending signals that, whoa, wait, you can't do this. So I think they'll probably do 25. We thought at the last meeting they might do 50, so one and done. We've been saying 2 25 basis point moves. I'd be surprised to see 50, but I do see that this Fed, many of the Fed members are very afraid that they will walk away with a legacy of letting inflation out of the bag again. So they might want to play it tough, but I think the bond market will give them an even more severe warning that they're playing with fire. Now, the other thing that's interesting about the bond market is if you look at the 2-year bond yield, it has already priced in the expectation that the Fed is going to move another 3 to 4 or 5 times, depending on how many 50 basis point moves are incorporated. And so this should be in the market. And if the bond market is successful in changing the Fed's mind, then we will have a very bullish environment. And I do believe that is what's going to happen. I don't know when, but I do believe that's what's going to happen. So inflation is a big problem. PPI was up 10% on a year-over-year basis in February. CPI was up 7.9%. What that meant was average hourly earnings were down 2.3% on a year-over-year basis. Now, we are seeing in inflation some signs that we may have peaked here. The Manheim used car index has dropped for 2 consecutive months, and it's hard to believe, but used car prices and new car prices were responsible at one point for nearly half of the boost in inflation. Well, in February, the Manheim index dropped 2.1%, and in March, 3.8%. Now, many people probably have been waiting to sell into the used car market, given the magnificent increase in pricing that we've seen. I think from trough to peak, it was 65% plus. So if they've been waiting and they're seeing prices fall now, they're going to try and push those cars in. That's how prices unwind at this time in a cycle. We're also seeing the oil price. It was very interesting to see it peak after Russia's invasion of Ukraine. It peaked at around $130. Now, I've been totally wrong on oil prices. Long term, we still expect them to go to levels we haven't seen since the 70s, since the oil embargo. And we stand by that. In fact, we stand even more by that now because what's happened with oil prices is destroying demand. We believe that demand peaked secularly in 2019. And I think these prices, we're seeing substitution. In St. Petersburg, we're seeing lots more scooters and bikes. Let's just put it that way. So oil price peaked at 130 on March 7th, came down a bit, tried to get to a new peak, and I think got to $114 a couple of weeks later, and now it's below 100. Now, there were forecasts out there just based on the supply shock that we would go to $200 or higher. And in real terms, that wouldn't have been much more of a shock than we saw in 08-09, but we know what happened in 08-09 as well. So maybe we certainly wouldn't like to get there. But I'm beginning to think that substitution, as well as a recession in Europe, a significant slowdown in China. I think if we saw the real numbers there, we'd probably be seeing more declines, given how much they've hit their property sector and are bearing down on the economy generally from a regulatory point of view. So we think that demand is falling, and would not be surprised at the end of the day to learn that 130 was the peak. Of course, we've seen an asset allocation shift towards crypto, towards gold. Crypto was fairly flat, as measured by Bitcoin, at least in the first quarter. Gold was up 7 to 8%. So both of those much better than both equities and bonds. And the dollar there, that was also up 3 to 4% in the first quarter. We're seeing the dollar continuing to move up against the expectations of the bears out there who believe that the twin deficit, so the federal budget deficit and the trade deficit, are going to cause an implosion in the dollar. The dollar is moving up, and I do believe there's a terms of trade reason for it. China's become more hostile to capital. Europe's in recession and on the border of a war. And the U.S. just seems like a safer place to be right now. And I'll end right now by just finishing up where I started. Disruptive innovation is inherently controversial, and the strategies focused on disruptive innovation are volatile, to be sure. And I just want to recount a little bit from my career and focused on disruptive innovation. Let's take Amazon, for example. Where I was in the business at the time, we bought it close to, it's going public. And I remember during the tech and telecom bust, it did come down dramatically. And the reason it did is because investors wanted their companies to be profitable, and Amazon was investing aggressively to capitalize on one of the biggest retail opportunities in history. And most investors couldn't see that, which was surprising to those of us who focus on disruptive innovation. And I can't tell you how many times the sell side and the buy side said, this thing's going bankrupt. This was a figment of Jeff Bezos's imagination, of Wall Street's imagination. And now we have a $1.6 trillion economy. The same with Apple. Nobody thought Apple could win against Nokia, Motorola, Ericsson. How could they? Apple had no share. They had all the share. How could this be? Well, Apple redefined the cell phone into a smartphone, a computer in our pocket. And now we have nearly a $3 trillion company. Bitcoin, when we first gained exposure to Bitcoin in 2015, many observers basically dismissed it as, well, that's a marketing gimmick from this new firm that's trying to find its way onto the map. And of course, I think that was at a $6 billion market cap or network value. Today, it's nearly $1 trillion. That was 2015 to now, 7 years. It's $1 trillion, from $6 billion to $1 trillion. And remember, people were calling it a Ponzi scheme. We had to suffer the arrows associated with that kind of criticism. And even Tesla, more recently, 2019. Tesla was not going to be able to scale its manufacturing. It was going to run out of money. The large auto manufacturers were going to run circles around it. And what do you know? It's up 20-fold since then, $1 trillion company as well. So